Time now for an in-depth look at the global markets this afternoon, and for that I'm joined on the line by Mr. Daniel Yu, global strategist at Yuanta Securities. Mr. Yu, thank you as always for making time today.
Thank you very much for having me today.
So with the crisis in Iran, global oil prices are at an 8-month high. Gold also rising for several sessions in a row to a 6-year high. Tell us about the connection between the Iran situation and those commodities, and also your outlook.
Sure. As you said, the gold prices as well as the oil price were rising quite rapidly due to the geopolitical risk that occurred. However, though, if you look at the price trend, the gold price hit as high as $1588. Now it's back down to about $1560. The reason why the gold price rises is because when there is a risk of economic recession exists, and if there is additional liquidity provided by central banks, and also if the inflation pressures comes through, and that results into the oil price rises. However, though, if you look at the risk of recession, we think that that is quite low at this point in time. And also the government will continue to provide liquidity. And in terms of the inflationary numbers, it doesn't seem to be that risky except the oil price. If you look at the oil price, yes, the geopolitical risk is resulting into sharp rise as high as $65 territories, but now it's back down to about $62.5. Main reason for that is because of the shale gas additional supply that will come through. The rig counts should rise as the oil prices remain there well above $60 territories. So we think that all in all, yes, there is a risk and concern about the prices keep rising, but we think that the overall trend is not going to be any drastic move that will result into that kind of concern. If you look at the economic conditions globally, it seems to be in a positive direction. And we do think that economic growth of the U.S. should recover this year to probably well above 2% territories that we have seen in the last 2 quarters. And if that's the case, then yes, the gold price as well as oil price should remain where we are, but we don't think that it's going to be any higher than the current level. It should be able to stabilize in the future.
Right. Well, Wall Street was up on Monday, apparently unfazed by Iran's threat of revenge against America. What should investors be looking at in this kind of situation? And just take us through the global markets.
Sure. As you said, quite a lot of people were concerned about this geopolitical risk. And one of the major U.S. investment banks have said that it is time to just buy gold and buy into the safety, the assets. And also some analysts were saying that this uncertainty could cause equity market correction by as high as 6 to 7% for global scale. However, though, as you said, on yesterday's stock prices movement indicates that that's not going to be the case. We also have said that to the investor that we are not in a phase where you need to take profits on equities. We are actually rather saying that it is time to take profits on gold, silver, and oil. We've been saying that the oil price should rise to as high as $65 when the prices were around $55. But we don't think that it's going to go up any higher than that. And inflation should be in check. On also gold and silver prices not going to go up that much because we don't think that there is going to be any kind of economic recession. Now, if that's the case, then we think that commodity price should be stable, corporate profits should be okay, and valuation should continue to be cheap at the current point in time. We're particularly recommending that any correction that we see in the growth stocks, including the fourth industrial revolution related stocks, we think that those price corrections should be a very good opportunity for investors to buy into the weakness. We think that most of these growth stocks have at least 30 to 40% upside potential over the next 12 to 18 months. And therefore, we think that any correction that we see here, because of the geopolitical risk and the risk appetite being low, we are recommending that to be used as the opportunity to buy into the weakness.
Well, speaking of weakness, the Korean markets picking up from their declines yesterday, but still far behind other markets. What's the story there?
Sure. As you said, Kospi is one of the worst performing market year to date this year. It is down about 1.2%, whereas the best performing market is the China's Shenzhen index, which is up more than 3.5% year to date. Now, main reason for this is because of the foreign investors movement. We know that the MSCI index changes affects that where foreign investors continue to buy the China, whereas they're selling the Kospi somewhat. And if you look at the foreign investors' net selling, it continued until today. But today they come back as buying about 128 billion won worth of Korean equities, and also they bought about 120 billion won worth of futures. That resulted into about 1% up of Kospi as well as Kosdaq. Now we're still concerned about the Korea's long-term futures. With the currently the government is much more focused on left-wing focused, and if you look at the earnings growth of the Korean companies, it seems to be quite timid, and also the corporate governance issue remains to be at risk. All that resulted into the negative sentiment for the Korean equity market. However, though, it is cheap market, and P multiples at low teens. And also, if you look at price to book, it's at 0.8 times book. And also, we are expecting the earnings to recover in the future. So what that means is that Korean market should do okay this year, along with the global equity market. But in terms of the outperformance, we're not sure about that.
All right, Mr. Yu, we'll have to pick up those points again sometime soon. Thank you for sharing your insights today.
Thank you very much.